Before we begin, a quick and important disclaimer. The information provided in this video is for educational and informational purposes only and does not constitute financial, legal, or mortgage advice. I am not a licensed financial advisor or mortgage loan originator. The mortgage industry is complex and regulations vary by state. Always consult with a qualified and licensed professional before making any financial decisions regarding a mortgage. Your financial situation is unique, and the content of this presentation is not a substitute for personalized professional advice. Imagine this for a second. There's a freelance web developer. Let's call her Jessica. For the last 3 years, Jessica has been absolutely crushing it. She's built a killer portfolio, has a roster of high-paying clients, and her income has soared past $150,000 a year. She's meticulous with her finances. Her credit score is a beautiful 780. She saved up over $80,000 for a down payment on her dream condo downtown. She's the perfect candidate for a home loan, right? She walks into her bank, the one she's been with for a decade, feeling confident, paperwork in hand. She fills out the application and a week later she gets the call. Denied. Not even a counteroffer. Just a flat, soul-crushing no. Why? Because her income doesn't come from a single predictable W-2 paycheck. She's self-employed. The bank's automated underwriting system took one look at her variable monthly income, her business write-offs, and even though she makes more than most of their traditionally employed applicants, the computer said she didn't fit inside their perfect little box. Jessica is not a rare case. She is a symbol of a massive and growing part of the American workforce being left behind by a rigid, one-size-fits-all lending system. Maybe you're not Jessica, the freelancer. Maybe you're a real estate investor looking to buy your 5th rental property, but the banks have told you that you have too many finance properties already. Maybe you're a small business owner who pours every dollar back into your company, so your personal tax returns don't reflect your true cash flow. Maybe you're a foreign national with significant assets, but no U.S. credit history. Or maybe you had a tough break a couple of years ago, a bankruptcy, a foreclosure, and even though you're back on your feet, the traditional mortgage world has branded you as unlendable for the next 7 years. If any of this sounds remotely familiar, if you've ever felt like the American dream of homeownership was being gatekept by a system that refuses to see the real you, then you are in exactly the right place. Because today, we are pulling back the curtain on the mortgage industry's best-kept secret. We are talking about the powerful, flexible, and often misunderstood world of non-QM loans. And I promise you, by the end of this video, you will understand a pathway to homeownership that you might have thought was permanently closed off to you. This isn't just about a different type of loan, it's about a different way of thinking about what it means to be a qualified borrower in the 21st century economy. So what is this box that Jessica, the investor, and the business owner couldn't fit into? To understand the solution, non-QM, we first have to understand the problem. And the problem has a name, the qualified mortgage, or QM. You have to rewind the clock. Think back to the 2008 financial crisis. The housing market collapsed in large part because of risky and irresponsible lending practices. Loans were being handed out with little to no verification of a borrower's ability to actually pay them back. When the house of cards came tumbling down, the government stepped in with sweeping new regulations, most notably the Dodd-Frank Act. Out of this act, a new standard was born, managed by the Consumer Financial Protection Bureau, or CFPB. This standard was the qualified mortgage. The QM rule was created with good intentions. It established a set of clear, strict guidelines that a mortgage had to meet to be considered safe and qualified. Think of it as a government-approved recipe for a low-risk loan. This recipe includes things like capping the borrower's debt-to-income ratio, typically at 43%. It requires full documentation of income using very specific methods, like W-2s and tax returns. It puts limits on the points and fees a lender can charge. For lenders, making QM loans is a no-brainer. If they originate a loan that follows all the QM rules to the letter, they are granted a safe harbor. This is a legal protection that shields them from lawsuits if the borrower later defaults, arguing they were given a loan they couldn't afford. For the bank, a QM loan is safe, it's simple, and it's legally protected. It's the path of least resistance. The problem is, this path is incredibly narrow. The QM framework is fantastic for the perfect borrower. The person who has worked the same 9-to-5 job for 5 years, gets a steady W-2 paycheck every 2 weeks, has minimal debt and perfect credit. The system is built for them. But what about everyone else? What about the millions of Americans whose financial lives don't fit that 1980s mold? The gig economy workers, the entrepreneurs, the retirees living off assets, the investors building empires? The QM box has no room for them. The system sees their unique financial situations not as a sign of success, but as a risk. It sees nuance and immediately labels it as unqualified. This is where our story takes a turn, because a group of forward-thinking lenders looked at this massive group of creditworthy, financially responsible people being rejected and saw not a risk, but an enormous opportunity. They realized that unqualified by the government's narrow definition didn't mean unqualified in the real world. And so, they started creating loans that exist outside that government-protected box. Loans for the people the system forgot. These are non-qualified mortgages. Non-QM. Don't let the name fool you. Non-qualified does not mean bad, or subprime or risky. It simply means the loan doesn't tick every single box on the government's QM checklist. That's it. It's a loan that uses common sense, alternative methods to verify that you, the borrower, have the ability to repay. Instead of just looking at your tax returns, a non-QM lender might look at 12 or 24 months of your bank statements to verify your business's cash flow. Instead of shutting you down for a past credit event, they'll look at your story and your current financial strength. Instead of a rigid debt-to-income ratio, they might use the income potential of an investment property to help you qualify. Non-QM is the answer for the new American workforce. It's the financial tool built for the modern economy. Over the next several minutes, we are going to break it all down. We're going to explore the most common types of non-QM loans, from bank statement loans for the self-employed to DSCR loans for real estate investors. We'll talk about who they're for, the pros, the cons, and the common myths that scare people away. This knowledge is your key. It's the key to getting the funding you deserve when the traditional system has told you no. It's the key to unlocking the front door to a home you've earned. So let's get into the specifics. Let's start by looking at the rock star of the non-QM world, the loan that has helped countless entrepreneurs just like Jessica finally achieve their dream of homeownership. Let's talk about the bank statement loan. The bank statement loan. The name itself tells you almost everything you need to know. It's a mortgage designed specifically for borrowers who can't qualify using traditional income documentation like W-2s or tax returns. Think about our friend Jessica, the graphic designer. Her tax returns, after all those legitimate business write-offs, showed a net income that made lenders laugh her out of the office. But her business bank account? That told a completely different story. It showed a healthy, consistent flow of cash coming in every single month from her clients. This is the fundamental shift in thinking that defines the bank statement loan. The lender agrees to ignore the tax returns. They say, okay, we understand that as a business owner, your tax strategy is to minimize your taxable income. That's smart business. But it doesn't help us see the true financial health of your enterprise. So instead, show us your bank statements. Show us the real cash flow. For Jessica, this was a revelation. It was the first time a lender was speaking her language. So, how does it actually work? It's not magic, it's just a different kind of math. Typically, a lender will ask for either 12 or 24 months of business bank statements. The more months you can provide, usually the better the terms you'll get. They take these statements and they perform a cash flow analysis. They add up all the deposits going into the account over that period. Let's imagine Jessica's business consistently deposits $20,000 every single month. That's $240,000 a year in gross revenue flowing through her business account. A conventional lender, looking at her tax returns, might see a net income of only $40,000 after expenses. Not enough to buy a shoebox in most cities. But a non-QM lender sees the $240,000 in deposits and starts from there. Now, here's the most important part of the calculation, and it's where people often get confused. The lender doesn't just assume that all $20,000 a month is Jessica's personal income. They know she has business expenses, software subscriptions, marketing costs, a co-working space, maybe a virtual assistant. So they apply something called an expense factor, or an expense ratio. This is a predetermined percentage that the lender uses to account for business expenses. The percentage can vary wildly depending on the industry. A service-based consultant who works from home might have a very low expense factor, maybe 20 or 30%. But a business that deals with physical goods like a small construction company will have a much higher expense factor, perhaps 60 or 70%, to account for materials and labor. In Jessica's case, as a freelance graphic designer, the lender determined her industry standard was a 50% expense factor. So they took her $20,000 in monthly deposits and multiplied it by 50%. The result? $10,000. That $10,000 becomes the qualifying monthly income they use for her application. Suddenly, Jessica went from having a qualifying income of about $3,300 a month based on her tax returns to a qualifying income of $10,000 a month based on her bank statements. That is a life-changing difference. That is the difference between being denied and being handed the keys to your dream home. Some lenders might offer an alternative to the fixed expense factor. They might allow the borrower to provide a profit and loss statement, or P&L, prepared by a licensed accountant. If that P&L shows that Jessica's actual expenses are, say, only 30%, the lender might use that figure instead, which would boost her qualifying income even higher. So who is this for? It's not just for graphic designers. It's for the real estate agent who works on 100% commission, the independent truck driver, the owner of the local pizza shop, the YouTuber who makes a great living but has unpredictable, fluctuating income. It's for consultants, gig workers, freelance writers, and any of the tens of millions of Americans who make up the backbone of the entrepreneurial economy. If you file a Schedule C on your tax returns, this loan was practically invented for you. Now you're probably thinking, this sounds too good to be true. What's the catch? And that's a fair question. There are, of course, trade-offs. Non-QM loans, including bank statement loans, are not a free lunch. First, the down payment requirements are typically higher than for a conventional FHA or VA loan. While you can sometimes find programs that go as low as 10% down, it's more common to see requirements for 15%, 20%, or even 25% down. The lender is taking on a perceived higher risk by not using tax returns, so they want you to have more skin in the game. Second, the interest rates are generally going to be a bit higher. We're not talking about predatory double-digit rates, but you can expect the rate to be anywhere from a half a point to maybe 2 full percentage points higher than the absolute best rate you see advertised for a perfect W-2 borrower. Again, this is the lender's way of pricing in the additional risk. You are paying a premium for the flexibility and the access to a financial tool that is custom-built for your unique situation. For most self-employed borrowers, paying a slightly higher rate is an infinitely better option than not being able to buy a house at all. Third, your credit score still matters. A lot. This is a common misconception. Non-QM does not mean bad credit. In fact, for a bank statement loan, most lenders will want to see a credit score of 660, 680, or even 700 and above. They are being flexible on the income documentation, so they need to be confident that you are responsible with your other financial obligations. And finally, you need to be organized. You will need to provide clean, easy-to-read bank statements. If your business account is a chaotic mess of transfers from personal accounts, Venmo transactions with friends, and undocumented cash deposits, it's going to raise red flags. The cleaner your statements, the easier the process. For Jessica, this was the path forward. She spent a weekend gathering 24 months of her business bank statements. Her accountant drafted a simple P&L for her, and she found a mortgage broker who specialized in non-QM lending. This is key, because your average big-box bank teller might not even know what a bank statement loan is. A few weeks later, she had a pre-approval letter in her hand. A pre-approval based not on what the IRS said she earned, but on the reality of the thriving business she had built from scratch. She was finally able to compete in the market, make an offer on a home with a small yard for her dog, and get it accepted. The feeling of validation was immense. She wasn't a risky borrower. She just had a different kind of income, and she had finally found a loan that understood that. The bank statement loan is a powerful tool. It's a game changer for entrepreneurs. But it's just one weapon in the non-QM arsenal. What if you're not self-employed? What if you have a great W-2 job, plenty of income, but your path to homeownership is blocked by a different kind of obstacle? What if you had a major life event a couple of years ago? A bankruptcy, a foreclosure, or a short sale? On paper, you're a pariah to the conventional lending world for up to 7 years. They see that black mark on your credit report and the conversation is over. But what if there was a way to get a mortgage just 1 or 2 years after that event? What if the non-QM world had a solution designed specifically for people who have recovered financially and are ready for a second chance? Well, it does. And that's exactly what we're going to break down next. This solution is often called a recent credit event loan. And to understand its power, I want you to meet someone. Let's call her Sarah. 5 years ago, Sarah's life got turned upside down. A difficult divorce, followed by an unexpected medical crisis, left her financially devastated. She was a freelance graphic designer, and with everything going on, her business suffered. She burned through her savings, maxed out her credit cards trying to stay afloat, and ultimately had to make the painful decision to file for Chapter 7 bankruptcy. It was a fresh start, but it left a massive scar on her credit report. A scar that traditional banks see as a permanent brand of being high risk. Now fast forward to today. Sarah's thriving. She's rebuilt her design business from the ground up. She's landing major clients, her income is higher and more stable than it's ever been, and she's been meticulously saving. She has a $70,000 down payment sitting in the bank, her credit score is back in the mid-600s and climbing, and for the last 3 years she hasn't missed a single payment on anything. Not her car, not her new credit cards, nothing. She is the very picture of financial recovery. So she walks into a big bank, ready to finally buy a small condo for herself. She presents her case. Strong income, huge down payment, perfect recent payment history. The loan officer seems impressed. They run her application. And then denial. Why? Because the rulebook for conventional loans, the one written by Fannie Mae and Freddie Mac, is incredibly rigid about this. For a Chapter 7 bankruptcy, the standard waiting period before you can even be considered for a conventional mortgage is 4 years. 4 years from the date of discharge. Sarah's only 3 years out. For a foreclosure, the waiting period is even longer. A staggering 7 years. A short sale? That'll be 4 years, thank you very much. The conventional lending world looks at Sarah's bankruptcy from 3 years ago, and the algorithm simply says, no. It doesn't care about her incredible recovery. It doesn't care about her high income or her massive down payment. The rule is the rule. The clock hasn't run out yet. For Sarah, and for millions of Americans like her who have hit a rough patch and fought their way back, this feels like a punishment that never ends. It's a wall. This is where non-QM doesn't just open a door. It builds a whole new entrance. A non-QM lender specializing in recent credit event loans looks at Sarah's file with a completely different philosophy. They aren't governed by Fannie and Freddie's rigid waiting periods. Instead of focusing on the event that happened 3 years ago, they focus on the story of what's happened since the event. Their first question isn't, when was the bankruptcy? Their first question is, what has your financial life looked like since the bankruptcy? They see her perfect 36-month payment history on her car and credit cards. That's a massive green flag. It demonstrates re-established credit and a commitment to financial responsibility. They see her $70,000 down payment for a $300,000 condo. That's over 20% down. This is what the industry calls skin in the game. It tells the lender that Sarah is personally and significantly invested in this property, which dramatically reduces their risk. If she has a huge chunk of her own money tied up in the home, she is far less likely to ever walk away from it. Then they look at her bank accounts and see that even after making that huge down payment and paying closing costs, she'll still have over $20,000 left in savings. These are called post-closing reserves. Having 6 to 12 months worth of mortgage payments in the bank after the deal is done is an incredibly powerful compensating factor. It's a safety net. It shows the lender that if Sarah's business has a slow month, she can still easily make her mortgage payment without breaking a sweat. So let's put it all together. The non-QM underwriter sees a borrower who had a major life event. Yes. But since then, she has proven her income, re-established perfect credit, saved a significant down payment, and built up a robust financial cushion. The conclusion they come to is fundamentally different from the conventional lenders. They see a resilient, responsible borrower who has weathered a storm and is now in a stronger financial position than ever before. They see a good risk. And so, Sarah gets an approval. Now, is there a catch? In a way, yes. And it's important to be completely transparent about this. This isn't a free pass. Because the lender is stepping outside the safe government-backed box, they are taking on more perceived risk. And in the world of lending, risk is always priced into the interest rate. Sarah's interest rate on her non-QM loan will almost certainly be higher than the absolute best advertised rates for a conventional mortgage. It might be 1, 2, or even 3 percentage points higher depending on her exact scenario, how much time has passed since the bankruptcy, her credit score, her down payment size, and so on. But here's the critical piece of the puzzle. For Sarah, the choice isn't between a 5% conventional loan and a 7% non-QM loan. The choice is between a 7% non-QM loan that allows her to buy a home today and build equity, or no loan at all. It's the choice between continuing to pay ever-increasing rent for another year or two while she waits for the conventional clock to run out, or starting her journey as a homeowner right now. and that non-QM loan isn't a life sentence. It's a bridge. Sarah can take this loan, buy her condo, and continue making her payments on time. In a couple of years, once her bankruptcy has aged past the 4-year conventional waiting period, and her credit score has continued to improve, she can simply refinance out of the non-QM loan and into a top-tier conventional loan with a lower rate. She used the non-QM loan as a strategic tool to get from point A to point B. This principle applies to so many situations beyond a divorce. Think about the small business owner whose company failed during the 2020 lockdowns, leading to a foreclosure, or the family that faced a 6-figure medical bill that forced them into bankruptcy, or even someone who went through a period of unemployment and had a series of late payments and collections. These are not bad borrowers. These are people who experienced a life event. Non-QM provides a path back to homeownership based on the reality of their present financial strength, not the ghost of their past financial hardship. It's a system based on common sense underwriting, looking at the complete picture of the person, not just a single data point on a calendar. So we've seen how non-QM can help people with a credit history that doesn't fit the perfect mold. But what about people whose income doesn't fit the mold? What if you're a successful business owner, a freelancer with a thriving gig, or a real estate investor who legally and smartly writes off so many expenses on your tax returns that on paper, you look like you're barely making any money? Conventional lenders look at that tax return, your net income, and they'll laugh you right out of the room. But non-QM, well, non-QM has one of its most powerful and revolutionary tools for exactly this person. A tool that ignores your tax returns entirely. And that tool is what we're going to dissect next. It's called a bank statement loan. And it does exactly what it sounds like. Instead of asking for your W-2s or your tax returns, a lender using this program will ask for your bank statements. Usually 12 months, sometimes 24 months of your business bank statements. They are going to completely and totally ignore what your tax return says you earned. They don't care. They know that for a business owner, taxable income and actual cash flow are two wildly different universes. What they care about is the real tangible cash that is flowing into your business month after month after month. So how does it actually work? It's surprisingly simple, but the details are what matter. First, the lender will collect your bank statements. Let's say they ask for the last 12 months. They will then go through every single statement and add up all of the deposits, every client payment, every transaction, every dollar that came into that account. Let's say over 12 months you had a total of $240,000 in deposits. That's an average of $20,000 a month. Now, a conventional lender looking at your tax return might see that you only claimed $60,000 in income after all your brilliant deductions. They qualify you based on that $60K. But the non-QM lender sees the $240K in gross revenue. But they know you have expenses, right? You're not just pocketing all $240,000. So here's the magic part. Instead of asking you for a mountain of receipts and a complex profit and loss sheet, they do something much simpler. They apply what's called an expense factor. This is a predetermined percentage that they use to estimate your business expenses. This percentage can vary based on your industry. For example, if you're a freelance consultant working from home, your expenses are probably pretty low. The lender might use a 20% expense factor. So they'll take your $240,000 in deposits, subtract 20%, and bam! They will use the remaining $192,000 as your annual qualifying income. Compare that to the $60,000 on your tax return. It's a world of difference. If you're, say, a long-haul trucker, your expenses are much higher: fuel, maintenance, insurance. So your expense factor might be 50%. A restaurant owner might have a 60% expense factor to account for food costs, staff, and rent. The lender has guidelines for all of this. They look at your profession and apply a reasonable standard. The bottom line is they are qualifying you based on a logical assumption of your cash flow, not the taxable income you strategically and legally reduced. This is a revolution for millions of Americans. Think about who this helps. The freelance graphic designer, the independent software developer, the gig worker driving for Uber and delivering for DoorDash, the real estate agent who is a 1099 contractor, the insurance salesman working on commission, the owner of the local coffee shop, the electrician, the plumber, the wedding photographer, anyone who files a Schedule C on their tax return and is a master at finding every possible deduction to lower their tax bill. For years, these people, maybe you, have been punished by the mortgage system for being smart business owners. You were told you had to choose. Either pay a massive tax bill you don't legally owe, or give up on the dream of buying a decent home. The bank statement loan says you don't have to make that choice anymore. Let's make this real. Imagine a woman named Sarah. Sarah is an incredible interior designer. She's in high demand. Last year, she brought in $180,000 in revenue. All of it is deposited right into her business checking account. Consistent, verifiable cash flow. But she also had real expenses. She bought new design software, she rented a small office space, she traveled to meet clients, she spent a ton on marketing. After her accountant worked their magic, her tax return showed a net income of just $55,000. Sarah and her husband want to buy a home for $600,000. They go to their local big bank, who looks at her $55K, combines it with her husband's salary, and tells them they can afford a $350,000 condo. They're crushed. Then a mortgage broker tells them about non-QM. They find a lender who offers a bank statement loan. The lender looks at Sarah's 12 months of statements and sees the $180,000 in deposits. They see she's an interior designer and apply a 30% expense factor. They subtract $54,000 for assumed expenses. Her qualifying income is now $126,000. Not $55,000. It's more than double. That $126K, combined with her husband's salary, suddenly gets them approved for the $600,000 house they fell in love with. For Sarah, this wasn't just a loan, it was validation. It was a system finally recognizing how her business actually works. Now I know what you're thinking. This sounds too good to be true. What's the catch? And you're right to be skeptical. There are trade-offs. This isn't a free lunch. The first and most important one is the interest rate. The interest rate on a non-QM bank statement loan will almost always be higher than on a conventional Fannie Mae or Freddie Mac loan. It could be 0.5% higher, a full percent higher, or even more, depending on your credit score and down payment. And why is that? Comes down to risk. From the lender's perspective, a tax return verified by the IRS is the gold standard of documentation. A loan based on bank statements is, in their eyes, slightly riskier. They are taking a bit of a leap of faith. And in the world of finance, higher risk always means a higher price. You're paying a premium for the flexibility. You're paying for the privilege of using a program that understands the realities of being self-employed. The second catch is the down payment. While some conventional loans let you get in with as little as 3% down, that's extremely rare in the non-QM world. For a bank statement loan, you should expect to need a larger down payment. 10% is often the bare minimum, and 20% or even 25% down is much more common. Again, this is about risk. The lender wants you to have more skin in the game. If you have a significant financial stake in the property from day one, you are statistically far less likely to default. And the third thing to know is that this is not a no-doc loan. That's a myth. You still have to provide extensive documentation, it's just different documentation. You'll need those 12 or 24 months of bank statements and they need to be clean. Lenders will scrutinize them. They don't want to see a bunch of large, unexplained cash deposits. They don't want to see a history of bounced checks or non-sufficient funds fees. They want to see a stable, professionally managed account. Pro tip: if you're thinking about using this type of loan in the future, start preparing now. Keep your business and personal finances completely separate. Have a dedicated business account where all your revenue goes. Pay yourself a regular transfer to your personal account. The cleaner your statements, the smoother the process will be. So yes, there are trade-offs. A higher rate, a bigger down payment, and a need for meticulous record keeping. But for the right person, for that business owner, that freelancer, that gig worker, these trade-offs are not deal breakers. They are the calculated cost of entry into homeownership. It's the price you pay to have a lender finally look at your $240,000 in cash flow instead of your $60,000 of taxable income and say, yes, we get it. You're approved. The bank statement loan is arguably the flagship product of the non-QM world, a true game changer for the self-employed. But what if you're not self-employed? What if you have a perfectly good W-2 job, you make great money, but your problem isn't income? It's something else. Maybe you just went through a bankruptcy last year. Or a foreclosure. The big banks and their automated systems will see that on your record and shut the door in your face. They'll tell you to come back in 3, 5, or even 7 years. But what if you didn't have to wait? What if there was a way to get a mortgage, even with a major credit event that recent in your rearview mirror? Well, there is. And that's where we're going next. This is the world of non-QM loans designed for people with recent major credit events. Think of them as second chance mortgages. They are built on a fundamentally different philosophy than conventional loans. A conventional loan looks at a past bankruptcy or foreclosure and sees a black and white rulebook. It sees a box that isn't checked, a waiting period that hasn't been met. The computer says no, and the conversation ends. A non-QM lender, on the other hand, is trained to ask a different question. They don't just ask what happened, they ask why it happened. This is a monumental shift in perspective. For so many people, a major credit event isn't the result of reckless spending. It's the result of life, a medical emergency that insurance didn't cover, a messy, financially devastating divorce, a small business, a lifelong dream that got wiped out by a global pandemic nobody could have predicted. These aren't character flaws, they are life events. Yet, the traditional mortgage system treats them all the same. It puts you in a penalty box and sets a timer for 2, 4, or even 7 years regardless of the circumstances. You're forced to sit on the sidelines, watching home prices climb, watching rents increase, feeling like you're being punished for something that was largely outside of your control. Non-QM lenders step into this gap. They operate on the principle of common sense underwriting. They look at you not as a credit score but as a person with a story. The key concept here is something called seasoning. Seasoning is just a fancy industry term for how much time has passed since the credit event occurred. For a conventional Fannie Mae loan, if you had a Chapter 7 bankruptcy, you typically need to wait 4 years from the discharge date. A foreclosure? You're looking at a 7-year wait. 7 years. A lot can happen in 7 years. You can rebuild your entire financial life from the ground up. But the conventional system doesn't care. The clock is the clock. Non-QM completely rewrites this timeline. How long do you have to wait after a bankruptcy with a non-QM lender? How about 2 years? How about 1 year? How about 1 day? Yes, you heard that correctly. There are non-QM loan programs that can get you into a home literally the day after your bankruptcy is discharged. Now, is that common? No. Is it easy? Absolutely not. You'll need what are called compensating factors, and we'll get to those in a second. But the fact that it's even possible shows you just how different this world is. Let's talk about a more realistic scenario. Meet David and Sarah. They owned a beloved local restaurant. For 10 years it was their life and it was successful. They had great credit, savings, everything was on track. Then 2020 happened. Lockdowns, supply chain issues, everything changed overnight. They drained their savings trying to keep their staff employed, trying to keep the doors open. But in the end, they had to make the heartbreaking decision to close down and declare business bankruptcy, which also impacted their personal credit. It's now 2 years later. David has a great job as a manager at a large hotel chain. Sarah went back to nursing. Their combined income is higher than it's ever been. They've managed to save up a 15% down payment for a new home. They're responsible, they're stable, they've recovered. They go to their local bank, the one they've used for a decade. The loan officer pulls their credit, sees the bankruptcy from 2 years ago, and shakes his head. "I'm sorry," he says. "Our guidelines require a 4-year wait. You're a great candidate, but the system won't let me do it. Come back in 2 years." 2 years. In today's housing market, 2 years can feel like an eternity. That's another $100,000 in equity they won't be building. That's another 24 months of paying their landlord's mortgage instead of their own. They feel defeated. It's the exact feeling of helplessness we talked about earlier. Then, a friend tells them about a mortgage broker who specializes in non-QM. They go in expecting the same story. But this time the conversation is different. The broker doesn't just look at the date of the bankruptcy. He asks, "Tell me what happened." So they tell him. They tell him about the restaurant, about the pandemic, about their fight to save their business. They show him their current pay stubs, their savings account, their new stable career paths. The broker nods. He sees the whole picture. He sees the story. He knows that the bankruptcy wasn't a reflection of their character, but a reflection of a once-in-a-century global event. He tells them, "I think we can help." He connects them with a non-QM lender who has a program specifically for this situation. A program that allows for a mortgage just 2 years after a bankruptcy, as long as there are strong compensating factors. And what are those compensating factors? It's everything David and Sarah brought to the table. It's the 15% down payment, which is larger than the minimum required. A larger down payment shows you have skin in the game and reduces the lender's risk. It's their high income and stable employment. They can clearly demonstrate right now that they can afford the monthly payments. It's the cash they have left over in savings even after the down payment and closing costs. These are called reserves, and they show the lender that if an unexpected expense pops up, they won't immediately default on the loan. The story, the down payment, the income, the reserves, these are the pillars of the common sense decision. The non-QM lender looks at all of this and concludes that David and Sarah are a good risk. They approve the loan. David and Sarah buy their home. They're back on the path to building wealth, providing a stable home for their family. All because one lender was willing to look beyond a single date on a credit report. Now, it is critically important to be honest about the trade-offs. This is not a free pass. A non-QM loan for a recent credit event will almost certainly come with a higher interest rate than a conventional loan. You might see a rate that's 1, 2, or even 3% higher than what your friend with a perfect 800 credit score just got. The fees might be a bit higher as well. And it's easy to look at that higher rate and think, I'm being penalized. But I want you to reframe that. This loan isn't a penalty. It's a bridge. It's a tool. It's getting you out of the penalty box today instead of 2 years from now. It's getting you into a home and allowing you to start building equity today. The plan isn't to keep this more expensive loan for 30 years. The plan is to use it as a strategic tool. You buy the house, you make your payments on time every single month for the next 2 years, and you continue to be financially responsible. Then, once you've crossed that original 4-year waiting period that the conventional lenders required, your credit score has recovered, and you've built up some equity in your home, you refinance. You replace the non-QM bridge loan with a standard, low-rate conventional mortgage. You've successfully used the tool to get from point A to point B years ahead of schedule. You didn't wait for the system to let you back in. You found a different door. This is the power of these loans. They provide a pathway back to homeownership for good people who have hit a rough patch. They replace rigid, automated rules with human logic and understanding. It's about looking at where you are today and where you're going, not just where you've been. But what if your credit is perfect? What if you've never had a bankruptcy or a foreclosure in your life? You have a 20% down payment saved up, you pay all your bills on time, and yet you walk into a bank and they still treat you like you're radioactive. Why? Because you don't have a W-2. You're one of the millions of self-employed Americans. You're a freelancer, a small business owner, a gig worker, and the traditional mortgage system simply doesn't know how to understand your income. For this massive and growing part of the American workforce, there is an entire other universe of non-QM loans designed just for them. And that's exactly where we're headed next. So let's dive headfirst into this alternate universe, starting with the largest group of people shut out by the qualified mortgage system: the entrepreneurs, the freelancers, the gig workers, and the small business owners. If you are one of the millions of Americans who works for yourself, you know the frustration. You might be making fantastic money, more than you ever did at a 9-to-5 job. Your business is growing, your cash flow is strong. But when you show your tax returns to a traditional mortgage lender, their face just drops. Why? Because you, like any smart business owner, take deductions. You write off your business expenses, your home office, your mileage, your software, your supplies, that new piece of equipment. You do this to lower your taxable income, which is financially prudent. But in the rigid black and white world of qualified mortgages, that lower net income on your Schedule C is the only number they see. They look at your $200,000 a year business and, after deductions, they see a qualifying income of maybe $50,000. And just like that, the dream of homeownership evaporates. They can't approve you for the loan you need, and you're left feeling penalized for your own success. This is the exact problem the most popular type of non-QM loan was created to solve. It's called the bank statement loan. And for the self-employed, this isn't just a loan product. It's a lifeline. It is a fundamental paradigm shift in how income is viewed. Instead of looking at your tax returns, which show what's left after expenses, a bank statement loan looks at what's coming in. It focuses on the lifeblood of your business, your cash flow. The lender is making a common-sense assessment. If this much money is consistently flowing through your accounts month after month, you can clearly afford a mortgage payment. They are looking at the reality of your financial health, not the version of it you present to the IRS. So how does it actually work? It's brilliantly simple. Instead of providing 2 years of tax returns and W-2s, you provide your bank statements, typically for the most recent 12 or 24 months. Most lenders prefer business bank statements, but some programs allow you to use personal statements if that's where your business revenue is deposited. The lender's underwriting team will then go through these statements and add up all the qualified deposits for each month. They're looking for consistent business revenue, not one-time transfers from your savings account or a birthday check from your grandma. Once they have the total deposits for the 12 or 24-month period, they calculate a monthly average. Let's use a real-world example. Imagine you're a freelance marketing consultant. Over the last 24 months, you've consistently deposited about $20,000 a month into your business bank account. Some months it was $25,000, some it was $18,000, but it averages out to $20,000. A traditional lender looks at your tax return and sees you only claimed $70,000 in net income after all your write-offs. That gives you a qualifying monthly income of less than $6,000, which won't get you very far in today's housing market. But a non-QM lender using a bank statement program sees it differently. They see your average monthly deposit of $20,000. Now, they know you have business expenses, so they don't just use that full amount. They apply what's called an expense factor. This is a predetermined percentage meant to account for the costs of running your business. For a service-based business like a consultant, this expense factor might be 30%. For a business that sells physical goods and has a higher cost of goods sold, it might be 50% or more. So, they take your $20,000 average monthly deposit and subtract the 30% expense factor, which is $6,000. Your resulting qualifying monthly income is now $14,000. $14,000 versus $6,000. It's more than double what the traditional lender came up with. Suddenly, you're not just getting a loan. You're getting approved for the home you actually want and can genuinely afford. All because the lender chose to look at your cash flow instead of your tax bill. This is the power of the bank statement loan. It aligns the mortgage process with the reality of being a modern entrepreneur. But what if your business is a little more complex? What if your deposits are inconsistent, or you have a lot of transfers that make your bank statements look messy? There's another powerful non-QM tool for that, and it's called the Profit and Loss or P&L statement loan. This option can be even more streamlined. Instead of providing stacks of bank statements, you provide a profit and loss statement for your business, usually covering the most recent 12 months, plus a year-to-date P&L for the current year. But here's the critical part. This P&L statement must be prepared and signed by a licensed third-party tax professional, like a certified public accountant or CPA. In some cases, it can be prepared by the business owner and then reviewed and signed off on by the CPA. This is a loan based on a professional attestation. The non-QM lender is essentially trusting the professional judgment and licensure of your accountant. They are relying on your CPA's expert opinion that the P&L statement is a fair and accurate representation of your business's profitability. The beauty of this is that it often requires no bank statements and no tax returns whatsoever. The P&L becomes the primary income documentation. Your CPA, who understands the nuances of your business far better than any bank underwriter ever could, is the one verifying your income. This can be a huge advantage for business owners who have a solid, long-term relationship with their accountant. It's faster, it's cleaner, and it allows for a more detailed and accurate picture of your business's true profitability, especially if you had significant one-time expenses or investments during the period that might make your bank statements misleading. The lender is underwriting the professional opinion of your CPA, and for many established business owners, this is the cleanest path to a mortgage. Now let's get even more specific. There's a third hyper-focused type of non-QM loan for a very specific kind of self-employed person: the independent contractor who lives on 1099s. This is the 1099 income loan. If you're a real estate agent, an insurance agent, or a freelance software developer who works with just a few major clients, you probably don't have a traditional business with thousands of little deposits. Instead, you get a few big checks, and at the end of the year you receive a 1099 NEC form from each client showing how much they paid you. For you, a bank statement loan might be overkill, and a P&L might be unnecessary. The 1099 loan is designed for pure simplicity. Lenders will look at the gross income reported on your 1099s for the past 1 or 2 years. That's it. They take that top-line number, maybe apply a very small standard expense factor, say 10%, and use the result as your qualifying income. They completely and totally ignore your tax returns. They don't need to see your write-offs for mileage, your marketing expenses, or anything else. They look at the 1099, see you were paid $250,000 last year, and they qualify you based on that gross number. It is the most direct and straightforward way for a high-earning independent contractor to get a mortgage. It bypasses all the paperwork and all the complexity and gets right to the heart of the matter. How much money did your clients pay you? Bank statement loans, P&L loans, and 1099 loans. These three programs form the core of the non-QM universe for the self-employed. They are all forms of what the industry calls alternative documentation, or alt-doc loans. They aren't subprime. They aren't handing out money to people who can't afford it. They still require solid credit, a significant down payment, and cash reserves. The only thing that's different, the revolutionary difference, is how they verify your income. They've simply created new common-sense tools to measure the financial success of the people who are building the modern American economy. They've chosen to look at cash flow, professional attestations, and contract income, instead of just a single line item on a tax form. But what if your income doesn't come from a job or a business you run yourself? What if your primary source of income comes from other properties? For the massive and growing world of real estate investors, the non-QM space has developed an entirely different set of tools that are, in many ways, even more revolutionary. These loans don't just look at income differently. Sometimes they don't look at your personal income at all. And that's where we're going now. So let's talk about the most powerful tool in the real estate investor's toolbox. A loan that completely ignores your personal paycheck, your W-2, your tax returns. It sounds like a fantasy, right? Especially in a post-2008 world. But it's very real, and it's called a DSCR loan. DSCR stands for Debt Service Coverage Ratio. And I know that sounds like something an accountant would say to put you to sleep. But stick with me, because understanding this one concept can unlock your ability to buy rental properties almost indefinitely. Here's the core idea. A DSCR loan qualifies you for a mortgage based on the property's ability to pay for itself. The lender isn't asking, "Can you afford this mortgage?" They're asking, "Can this house afford this mortgage?" It's a fundamental shift in thinking. They treat the investment property like a standalone business, because that's exactly what it is. The ratio in DSCR is a simple calculation. It's the property's gross monthly rent divided by the total monthly mortgage payment. And that mortgage payment is what we call PISA. Principal, interest, taxes, insurance, and any association dues. Let's make this real. Imagine you find a duplex you want to buy as a rental. Both units together will rent for a total of $4,000 a month. After your down payment, the new mortgage, the full PISA, is going to be $3,200 a month. To get the DSCR, you just divide the rent by the payment. So $4,000 divided by $3,200. That gives you a DSCR of 1.25. What does 1.25 mean? It means the property generates 1.25 times the income needed to cover its debt. Or, to put it another way, it makes 25% more than the mortgage payment each month. For a lender, that's a beautiful number. It shows the property is not just self-sufficient, it's profitable from day one. It has a cash flow cushion. Most DSCR lenders are looking for a ratio of 1.25 or higher. Some will go down to 1.15, some even to a flat 1.0, which means the property breaks even. The rent exactly covers the mortgage payment. You might wonder, why would anyone buy a property that just breaks even? Well, they're not in it for the monthly cash flow. They're betting on appreciation. They believe the property's value will go up over time, and they're letting the tenant pay off the mortgage for them while they wait. Now, here's where it gets really interesting. Because this loan doesn't look at your personal income, it completely solves the biggest problem that ambitious real estate investors face. Personal debt-to-income ratio, or DTI. See, with a conventional loan, every time you buy a rental property, the new mortgage payment gets added to your personal debts. Even if the property is cash flowing like crazy, Fannie Mae and Freddie Mac have strict limits on how high your DTI can be. After 2, 3, maybe 4 properties, most investors hit a wall. Their DTI is too high to qualify for another conventional loan, and their journey stops. DSCR loans blow that wall to pieces. You could have 10 rental properties and be applying for your 11th. The lender won't even ask about the mortgages on your other 10 properties, as long as they are also performing. They are only looking at the deal in front of them. Does this new property have a DSCR that makes sense? If the answer is yes, you're approved. This is how you see investors scale their portfolios to 10, 20, even 50 properties. They're not using the same tools as the average homebuyer. They're using a business-focused tool for a business purpose. So who is this for? It's for the serial investor. It's for the self-employed person whose tax returns show a low net income because they have a great CPA who maximizes their deductions. With a DSCR loan, those tax returns are irrelevant. It's for the high-income W-2 employee who wants to build a rental portfolio on the side without their main job's DTI getting in the way. It's even for foreign nationals who want to invest in U.S. real estate but have no U.S. credit or income to show. But what if the numbers don't quite work? What if you find a great property in a high appreciation area, but the rents are low right now, so the DSCR is below 1.0? Let's say it's 0.8. This means the rent only covers 80% of the mortgage payment. Conventionally, that's a dead deal. But in the non-QM world, some lenders even offer what's called a no-ratio DSCR loan. They'll approve the loan even if the property is losing a little money each month. Why on earth would they do that? Because they are not one-dimensional thinkers. They'll look at other factors. Do you have a large down payment, maybe 30 or 40%? Do you have significant cash reserves in the bank? Is the property in a neighborhood where values are skyrocketing? If they see that you, the investor, are financially strong and are making a smart long-term play, they'll still do the loan. They are pricing for risk. The interest rate might be a bit higher, but the deal gets done. This flexibility is simply unheard of in the conventional mortgage world. DSCR loans have fundamentally changed the game for real estate investors. But they are just one type of non-QM loan that sidesteps traditional income verification. There's another, equally powerful category for a completely different type of borrower. This is for the person who isn't necessarily a real estate mogul, but is asset-rich and income poor. Think about the early retiree who just cashed out their 401k and is sitting on $1 million, but has no job. Or the person who just sold their business for a few $1 million and now has no active income stream. Or even someone who received a large inheritance. These people are incredibly wealthy, but if they walk into a regular bank and show them their bank statements, the loan officer will say, "This is great, but where's your pay stub? Where's your W-2?" They can't get a loan. Enter the asset depletion loan, sometimes called an asset utilization loan. This is one of the most elegant and common-sense solutions in the non-QM space. A lender will look at your total verifiable assets, your stocks, bonds, mutual funds, retirement accounts, even cryptocurrency in some cases, and they will turn those assets into a qualifying monthly income for you. Here's how it works. Let's say you have a brokerage account worth $2 million. A lender won't assume you can use all of it because the market is volatile. So they might take a haircut. For stocks, a common haircut is 30%, meaning they'll only consider 70% of the value. So, your $2 million in assets is now treated as $1.4 million for qualifying purposes. Then they simply spread that amount over a period of time to create a monthly income. Some lenders will spread it over 360 months, the life of a 30-year loan. Others use a much shorter period, like 60 or 84 months, which creates a much higher qualifying income. Let's use the 360-month example. The lender takes your $1.4 million, divides it by 360, and voila! You now have a qualifying monthly income of $3,888. That's almost $4,000 a month in income that you can use to qualify for a mortgage, created out of thin air from your assets, with no job required. If the lender used a 60-month term instead, your qualifying income would be a staggering $23,333 a month. This is life-changing for people with high net worth but unconventional cash flow. It allows their wealth to actually work for them, to secure the financing they need for a home they can clearly afford. They don't have to sell off their assets and trigger a massive tax event just to buy a house in cash. They can use this smart, flexible loan to get the mortgage, keep their assets invested and growing, and live the life they've earned. So we have these incredible tools: DSCR loans for investors and asset depletion loans for the asset-rich. They both solve the problem of income by looking at the bigger picture, either the property's income or the borrower's total wealth. But what about the massive, growing part of the American workforce that falls in between? The people who do have income, often a lot of it, but it doesn't come in a neat W-2 package. I'm talking about the freelancers, the gig workers, the small business owners, the creators, the people whose income is a complex web of deposits from dozens of clients. For them, a traditional tax return can be a financial death sentence when applying for a mortgage. But the non-QM world has a brilliant solution for them too. And it might be the most popular and impactful non-QM loan of all. It's called a bank statement loan. And for millions of self-employed Americans, it's not just a loan product. It's the key that unlocks the entire dream of homeownership. Let's paint a picture. Meet Sarah. Sarah is an incredibly successful freelance marketing consultant. Last year, her business brought in over $200,000 in deposits. She's at the top of her game. She pays her bills on time, has great credit, and has saved up a healthy down payment. By every real-world measure, she is a financial rock star. But Sarah has a problem. She also has a very, very good accountant. Her accountant's job is to legally minimize her tax liability. So, after writing off her home office, her new laptop, software subscriptions, travel to conferences, a portion of her car and cell phone bill, all the legitimate expenses of running a business, her final adjusted gross income on her tax return was only $65,000. When Sarah walks into a traditional bank, they look at that $65,000 number. They run their calculations, and they tell her she can qualify for a loan that might get her a small condo, miles away from where she wants to live. She's crushed. The bank is looking at her tax-optimized income, not her actual cash flow. Her accountant's greatest triumph has become her mortgage lender's worst nightmare. This is the exact scenario the bank statement loan was designed to solve. Instead of asking for tax returns, a non-QM lender says, "Show us your business bank statements. Show us the actual cash coming into your business." They typically want to see the last 12 or 24 months of statements. They're not looking at your write-offs. They're not looking at your deductions. They are looking at your revenue, your deposits. They are underwriting your loan based on the real-world health and cash flow of your business. It's a loan based on the reality of your business, not the paper reality you show the IRS. So how do they do it? How do they turn a series of monthly deposits into a qualifying income? This is where the magic happens, and it's a concept called the expense factor. A lender knows that just because Sarah had $200,000 deposited into her account, it doesn't mean that's all profit. She still has business expenses. So they apply a standard expense factor to her total deposits to arrive at a qualifying income. Let's break it down. Suppose over 24 months, Sarah had a total of $480,000 in business-related deposits. That's an average of $20,000 per month. The lender might say, for a marketing consultant, we'll use a standard 30% expense factor. They assume 30% of her deposits go toward running the business. So they take her $20,000 in monthly deposits and subtract 30%, which is $6,000. That leaves a qualifying monthly income of $14,000. $14,000 a month. That's $168,000 a year. Think about that. The traditional bank saw $65,000. The non-QM lender sees $168,000. It's the same person, the same business, the same bank account. The only thing that changed was the lens they were using to view her financial picture. One lender saw a tax return, the other saw a thriving business. With that qualifying income, Sarah can now afford the home she actually wants, in the neighborhood she wants to be in. She went from being seen as a moderate-risk borrower to a highly qualified buyer, almost overnight. This isn't just for marketing consultants. This is for the entire backbone of the American economy. The general contractor who writes off his truck, his tools and materials. The restaurant owner with massive food and labor costs. The real estate agent working purely on commission, writing off marketing expenses and brokerage fees. The YouTube creator, the e-commerce store owner, the freelance graphic designer, the truck driver who owns his own rig. For all of these people, a bank statement loan doesn't just level the playing field. It completely changes the game. Now, some lenders get even more granular. If you think the standard expense factor is too high for your business, you can sometimes provide a letter from your CPA or tax preparer. This letter can state that your actual expense ratio for your business is lower, say only 15% instead of the standard 30%. If the lender accepts this, your qualifying income goes up even higher. This gives you a level of control and customization that is simply impossible in the rigid, black and white world of conventional lending. But let's be perfectly clear. This is not a no-doc or stated income loan of the past. Those days are gone. You are still providing extensive documentation, it's just different documentation. The lender is going to scrutinize those bank statements. They want to see consistent, predictable deposits. They don't want to see large, erratic, one-off cash deposits that can't be explained. They want to see that your business is stable and has been for at least a year or two. They will verify that you actually own the business. You still need a good credit score and you still need a down payment. And that brings us to the trade-offs. Because there are always trade-offs. Non-QM lending is all about risk-based pricing. Because the lender is taking on a different and arguably slightly higher level of risk by not using IRS-verified income from a tax return, they compensate for that risk in two main ways. First, the interest rates on bank statement loans are typically a bit higher than on a conventional or FHA loan. We're not talking about a massive difference, but it could be 0.5%, a full percent, or sometimes more, depending on your credit score and down payment. For most borrowers, Paying a slightly higher interest rate is an infinitely better option than not being able to buy a home at all. They see it as the cost of entry, a price worth paying for a home that will appreciate in value. Second, the down payment requirements are usually higher. While you can get an FHA loan with just 3.5% down, a bank statement loan will often require at least 10%, and more commonly 20% down. The lender wants to see that you have more skin in the game. This reduces their risk and demonstrates your financial stability. So, is it worth it? For millions of entrepreneurs, the answer is a resounding yes. They understand that a home is more than just a place to live. It's the single greatest wealth-building tool for the average American family. Being locked out of that opportunity simply because their business is structured in a tax-efficient way feels fundamentally unfair. The bank statement loan corrects this. It's a modern solution for the modern economy. It acknowledges that the old way of earning a living, a W-2 from the same company for 30 years, is no longer the only way, or even the most common way, for many successful people. It empowers the very people who are out there creating jobs, taking risks, and building the economy. It gives them access to the same financial tools and opportunities as everyone else. It turns a story of frustration and rejection at a big bank into a story of success and empowerment. The self-employed are a massive and vital part of our country, but they're not the only group that finds themselves on the outside looking in when it comes to traditional mortgages. There's another huge category of buyer, one that is becoming more and more common: the real estate investor. These are people trying to build a portfolio of rental properties to create passive income and long-term wealth. But they often run into a wall. After they buy one or two properties using conventional loans, lenders often say, "That's it. Your debt-to-income ratio is too high. No more loans for you." Their personal W-2 income can only be stretched so far. But what if I told you there's a loan where the lender doesn't care about your personal income at all? They don't ask for your tax returns, your pay stubs, or your W-2s. All they care about is whether the property you're buying can pay for itself. This is the loan for the modern real estate investor. It's called a DSCR loan, which stands for debt service coverage ratio. And it's not as complicated as it sounds. In fact, the entire idea behind it is incredibly simple. The loan isn't being made to you, it's being made to the property. The lender is betting on the property's ability to generate income, not your ability to earn a salary. So how does it work? The lender looks at just two numbers. First, the total monthly rental income the property is expected to generate. And second, the total monthly housing payment for that property. That payment is often called PISHA, which stands for principal, interest, taxes, insurance, and any association or HOA fees. They take the monthly rent and divide it by the monthly PISHA payment. The result is the debt service coverage ratio. Let's put some real numbers on this. Imagine you want to buy a duplex as an investment property. Each unit can rent for $1,500 a month, for a total gross monthly rent of $3,000. Now let's say the total mortgage payment, the principal, interest, taxes, and insurance, comes out to be $2,500 a month. The lender does one simple calculation. They take the $3,000 in rent and divide it by the $2,500 payment. The result is 1.2. That's your DSCR. What does that 1.2 mean? It means the property generates 20% more income than is needed to cover the debt. To a lender, that's a healthy cash-flowing property. It's a good bet. Most lenders want to see a DSCR of at least 1.0, which means the rent exactly covers the mortgage payment. This is called breaking even. But many prefer to see a ratio of 1.15, 1.2, or even 1.25, which represents a solid positive cash flow. If the ratio is less than 1.0, it means the property has negative cash flow. It costs more per month than it brings in. In most cases, a lender won't approve a DSCR loan for a property like that, because from their perspective, the property can't pay its own bills. So who is this incredible loan for? First and foremost, real estate investors. If you're trying to scale a rental portfolio, DSCR loans are your best friend. Conventional loans from big banks often have a limit. They'll only let you finance a certain number of properties, usually around 10. With DSCR loans, there's often no limit. You can finance 15, 20, 30 properties. As long as each deal makes sense on its own, the lender will keep lending. It's also a lifeline for self-employed borrowers, just like the bank statement loan. Maybe you're a consultant, a YouTuber, or a small business owner. Your tax returns might show a modest income after all your business write-offs, but you have a great credit score and a hefty down payment saved up. A DSCR loan allows you to buy an investment property without your personal tax returns ever entering the equation. And here's a massive advantage. You can often purchase the property in the name of an LLC or a limited liability company. This is a huge deal for serious investors. It separates your personal assets from your business assets, offering a powerful layer of liability protection. If a tenant slips and falls, they sue the LLC, not you personally. This helps protect your primary home, your savings, and your other assets. Trying to get a conventional loan in an LLC name is notoriously difficult, if not impossible. With the DSCR loan, it's standard practice. The benefits are clear. There's no verification of your personal income, no W-2s, no pay stubs, no tax returns. This dramatically simplifies the paperwork, which often means you can close on the property much faster than with a conventional loan. You can buy unlimited properties and you can use an LLC for protection. Sounds almost too good to be true. And you know what they say about that. So what's the catch? There are a few, and you need to go into this with your eyes wide open. First, the interest rates on DSCR loans are almost always higher than on a conventional, owner-occupied mortgage. Lenders see these loans as slightly riskier, so they charge a premium. You might pay a full percentage point or more over the going rate for a standard home loan. Second, you'll need a larger down payment. For a conventional loan on a primary residence, you might get away with 3% or 5% down. For a DSCR loan, the minimum is almost always 20%, and more commonly, lenders will require 25% or even 30% down. They want you to have significant skin in the game. Third, while they don't care about your income, they absolutely care about your credit score. Lenders will still pull your credit report, and they'll want to see a strong history of you paying your debts on time. A high credit score will get you a better interest rate, while a lower score could get you denied, even if the property's numbers look fantastic. And here's a big one. The appraisal is everything. The appraiser doesn't just determine the value of the home. They also have to provide a professional opinion on what the property will rent for. This is called a comparable rent schedule. If you think a property will rent for $3,000 a month, but the appraiser's official report comes back saying the market rent is only $2,400, your DSCR calculation just fell apart. The entire deal can collapse based on that one number from the appraiser. Finally, you need to watch out for something called a prepayment penalty. This is very common with DSCR loans, and almost non-existent in the conventional loan world. A prepayment penalty is a fee the lender charges you if you pay off the loan too early, usually within the first 3 to 5 years. Why would they do this? Because they make their money on the interest you pay over time. If you buy a property, fix it up, and sell it 6 months later, you've paid them almost no interest. The penalty ensures they get a return on their investment. It's not necessarily a bad thing, but you have to know it's there and factor it into your investment strategy. Let's bring this to life with a quick story. Meet Maria. Maria is a brilliant web developer who works on a contract basis for several tech startups. Her income is fantastic, but it comes from multiple sources, and her accountant is a wizard at finding business deductions. On paper, her taxable income looks tiny. She wants to buy a fourplex in a growing neighborhood. She walks into a big national bank, and they laugh her out of the office. Her debt-to-income ratio is way too high based on her tax returns. Feeling defeated, she stumbles upon the world of non-QM loans and learns about DSCR. She finds a lender who specializes in them. The fourplex she wants to buy generates a total of $6,000 a month in rent. The new mortgage payment with taxes and insurance will be $4,800. The lender divides $6,000 by $4,800 and gets a DSCR of 1.25. It's a slam dunk. Maria has a 780 credit score and has 25% saved for the down payment. She creates an LLC, gets the loan approved in under 3 weeks, and closes on the property. She never once had to show the lender a tax return or a pay stub. She is now a real estate investor, building wealth for her future, all because a loan existed that judged the deal, not her day job. So the DSCR loan is a powerful tool for investors, the bank statement loan is a lifesaver for the self-employed, and the asset-based loan is a game-changer for those with high net worth. You're sold. You're ready to dive in. But there's a problem. You can't just walk into your local Chase or Bank of America and ask for one of these. So where do you find these magical unicorn loans? And more importantly, how do you avoid the predators that swim in these less regulated waters? That's what we're breaking down next. The answer, for the most part, is not at your big, national name brand bank. They live and die by the qualified mortgage rulebook. To find a non-QM loan, you need to venture into the world of specialized lenders. Your single most powerful ally in this quest is a good independent mortgage broker. Think of a mortgage broker as a personal shopper for your home loan. You don't work for a specific store. You have a client, and your goal is to find the best possible product from all the stores in the mall. A mortgage broker isn't tied to one lender. They have relationships with dozens, sometimes hundreds of different lenders, including wholesale lenders that don't even have a public-facing brand. You can't just call them up. They only work through brokers. And this is where the magic happens. A good broker knows the specific appetites of each lender in their network. They'll know that lender A loves DSCR loans in Florida, but won't touch a bank statement loan in California. They'll know lender B is fantastic with self-employed borrowers who have a 680 credit score, but lender C offers a better rate if your score is over 740. You tell the broker your story once. You provide your documents once. They then take your unique financial puzzle and shop it around to find the lender whose guidelines are the perfect fit. This saves you an unbelievable amount of time and frustration. Instead of you applying to 10 different places and getting 10 different rejections, the broker does the legwork, filtering out the no's before you ever see them and presenting you with the best yes. Beyond brokers, you also have direct non-QM lenders. These are often smaller, more agile financial institutions or online-focused lenders who have built their entire business around these non-traditional loans. You can find them with targeted online searches like bank statement mortgage lenders or asset depletion loan specialists. The key is to be specific about what you need. But this brings us to the critical multi-million-dollar question. With all these new names and unfamiliar companies, how do you separate the legitimate professionals from the predatory sharks? Because let's be clear, in any less regulated space, there will always be those looking to take advantage of people. Your first, second, and third line of defense is one simple, non-negotiable check: licensing. Every single legitimate mortgage loan originator and their company must be licensed in the state where you are buying property. There are no exceptions. And thankfully, the government has made it incredibly easy to verify this. You need to get familiar with a website called the NMLS Consumer Access. NMLS stands for the Nationwide Multi-State Licensing System and Registry. Think of it as the DMV for mortgage lenders. Before you engage seriously with anyone, get their name and their NMLS ID number. If they hesitate to give it to you, that's a giant flashing crimson red flag. Run. Once you have their ID number, or even just their name and company, go to nmlsconsumeraccess.org. It's a public website. Type in their information. You should see their photo, their employment history, the states they are licensed to operate in, and most importantly, any regulatory actions or disciplinary history against them. If they aren't on this website, they are not legally allowed to discuss loan terms with you or originate your loan. Period. This one simple 5-minute check can save you from a world of financial pain and potential fraud. Once you've verified they're legitimate, it's time to play detective. Go to Google. Type in the company's name and the loan officer's name followed by the word reviews. Look past the perfectly curated testimonials on their own website. Look at Google reviews, Zillow, Yelp, the Better Business Bureau. Don't just look at the star rating. Read the actual reviews, especially the negative ones. Are the complaints about minor communication issues? Or are they about serious problems like last-minute fee changes, bait-and-switch interest rates, or a failure to close on time? One bad review could be a disgruntled client. A pattern of the same complaint over and over again is a signal of how they do business. Next, pay close attention to transparency during your initial conversations. A good loan officer is an educator. They should be able to clearly explain why they are recommending a specific program for you. They should be upfront about the potential rates, the fees involved, and the documents you'll need. If a lender is cagey, if they pressure you to sign something immediately, or if they promise you an unbelievably low rate before they've even seen a single piece of your financial documentation, be very skeptical. The classic predatory move is to lure you in with a fantasy rate, get you deep into the process where you feel committed, and then hit you with the reality of higher fees and a worse rate, hoping it's too late for you to back out. When you get a real offer, you should receive a document called a loan estimate, or LE. This is a standardized, government-mandated form that breaks down all the costs of the loan. This document is your single best tool for comparing offers. Even in the non-QM space, lenders should provide a clear breakdown of costs that looks very similar to this. Don't just look at the interest rate. Look at the APR, the annual percentage rate, which bakes in many of the lender's fees and gives you a more accurate picture of the true cost of the loan over time. Scrutinize Section A of the loan estimate. These are the direct origination charges from the lender. This is where you can see if one lender is charging significantly higher points or underwriting fees than another. Compare the cash-to-close figure. Make sure you are comparing apples to apples. If one lender's estimate is wildly lower than others, ask them to walk you through it line by line. It's possible they've left something out, intentionally or not. So let's bring this all home. What is a non-QM loan? It's not a subprime loan. It's not a lesser loan. It is a sensible alternative path to homeownership, designed for the realities of the 21st century American economy. It's for the successful freelance graphic designer whose income shows up in 1099s and bank deposits, not a W-2. It's for the savvy real estate investor who wants to use the cash flow from a new property to qualify, not their personal tax returns. It's for the retiree with millions in a 401k but minimal monthly income, who wants to use their assets to buy a dream home near their grandkids. It's even for the person who hit a rough patch, a medical issue, a divorce that temporarily damaged their credit, but who is now financially stable and ready to own a home again. For decades, the mortgage industry has operated on a rigid, one-size-fits-all model. It was a system built for a post-war economy of company lifers and predictable pay stubs. But that's not America anymore. We are a nation of entrepreneurs, side hustlers, investors, and innovators. Our financial lives are more complex, more dynamic, and more diverse than ever before. The traditional mortgage box simply doesn't fit a huge and growing portion of creditworthy Americans. Non-QM isn't a loophole. It's an evolution. It's the financial world finally catching up, creating a new set of tools to measure financial strength in a way that makes sense for how people actually earn and manage their money today. The key is to approach it with your eyes wide open. Understand your own financial story. Seek out a licensed, reputable mortgage broker or lender who specializes in these products. Verify their credentials, read their reviews, and demand transparency every step of the way. Your financial story might not be written in the simple language of a W-2, but that doesn't mean you're not qualified. It just means you need a lender who is fluent in the language you speak. You need an underwriter who can read between the lines of a bank statement and see a thriving business, not just a series of deposits. So don't let a standardized form tell you what you're worth. Don't let the old rules lock you out of a future you've worked hard to build. The right loan is out there. It's time to find the right key, unlock the door, and walk into the home you've earned.